Good morning from London. I'm Anna Edwards alongside Kriti, Gupta and Valerie Tytel. We're an hour away from the opening trade. Here's what you need to know. US copper futures surged to a record after President Trump says he'll put a 50% tariff on the metal while also threatening 200% on pharmaceuticals. The American president says he's close to imposing a tariff rate on the EU, but talks continue. Europe is trying to protect key companies, including Airbus. Plus, UniCredit ramps up its consolidation plans, boosting its equity stake in Commerzbank to about 20%.
Let's check in on how these markets are faring this morning. We're seeing S&P futures flat to the downside. Some outperformance in European futures. Euro Stoxx 50 up 0.25%. The dollar is pretty firm today. We have euro dollar at 117.16. And Treasury yields rising for a sixth session in a row. The countdown to the opening trade starts right now.
I believe the tariff on copper, we're going to make it 50%. We'll be announcing something very soon on pharmaceuticals. We're going to give people about a year and a half to come in, and after that they're going to be tariffed if they have to bring the pharmaceuticals into the country, the drugs and other things into the country. They're going to be tariffed at a very, very high rate, like 200%.
50%, 200%, some very big numbers being thrown around, except we've graduated from country-specific tariffs to sector-specific tariffs, but maybe more that are coming down the pike. Let's dive into the very first number, though. 50% on copper. That's what's been threatened here. We know the copper industry is something that Donald Trump has had his eye on for quite some time. We revisited this thought, I want to say a couple of months ago, before Liberation Day. This idea that there are a lot of dependencies on copper that is not produced within the United States. It was only a time before Donald Trump put this into play and already showing up in the markets.
Yeah, absolutely. And Valerie, we saw this in the sort of arbitrage we now see between the London copper market and the US copper market. And the price is looking really different, responding really differently. Interesting that Goldman Sachs were estimating that traders were pricing in a 14% tariff here, ahead of the announcement of 50 yesterday. So that goes to support the reason why we saw copper prices in the US jump to an all-time high as a result.
Yeah, and questions about whether these stockpiles will continue to grow in the US as, these factories try to protect themselves, try to front-run these tariffs. I, for one, was interested to hear that 100 pounds of copper is used in one electric car. We know that copper is pervasive among many industries, home building being one as well. That's the main use of copper globally, but its impacts are really broad-based. And the question we got to start asking ourselves, is this going to lead to some more producer price inflation?
It's fascinating that you talked about the car manufacturing, the EV space of it, because that's kind of where the rollback is coming from in terms of that kind of support. But the manufacturing capabilities is another key piece. If Donald Trump wants to bring manufacturing back to America, that requires infrastructure build-out, to your point, the home building, but also facilities, et cetera, AI grids, et cetera. That's going to all need that copper, and you need to be doing it at a price that is affordable to be able to help the manufacturing story. Does this help that cost?
Yeah, the data center story, the electrification story, so many of the transitions that we talk about in industry right now requiring copper. I'm really interested in the pass-through of this kind of tariff into inflation, because we've spent a lot of time thinking about when's that going to come. Powell and team have been talking about the summer. They're very alert to it. We had a conversation with Paul Donovan yesterday talking about how some of these things, because of inventories, they'll take a while to pass through. Others are more immediate. But here we've had a huge inventory build, haven't we, with a lot of copper going into the United States in the first quarter. Citi talking about how there's now going to be an abrupt close in the window for further significant US-bound copper shipments. So if very little goes in, what kind of push higher in prices do you get if the tariffs aren't actually going to be paid substantially until the start of next year?
Yeah, and a big question, behind what you're just mentioning there are, do these factories price off of what their current inventory costs them, or are they looking at the replacement cost of that inventory when pricing new goods? But it's definitely something to keep our eye on. Look at this graphic on screen. I mean, copper is used in essentially so many things across the U.S. economy.
Let's talk about what is happening with the European story. And we should mention pharmaceuticals in that context, because we'll be alert to see if we get any response in any of the share prices of the pharma companies. President Trump, as we just heard, talking about 200%, possibly the tariff on pharmaceuticals, but not yet. Give them a year. He's hoping that, of course, some of that manufacturing of pharmaceuticals by US companies and other global businesses comes back onshore to the United States. That's the aim. But where does this leave Europe outside of the pharma story? Well, talks continue, basically. But President Trump has said he's getting close to sending a letter. Now, is this just part of a negotiation tactic? We'll have to wait and see. Our reporting suggests that Europe is trying to protect some key businesses and some key industries. Airbus in particular, I mean, they are a big manufacturer in Alabama, and so the Europeans perhaps sense that maybe the US will be more minded to be generous on that particular front, because if they put a big tariff on aircraft, then that could hurt their own business, perhaps, if parts are coming into the United States. And so one of the factors that Europe are looking at, they're looking at what's critical industry, they're looking at what the US is going to be kinder on, and they're also looking at the leverage that the individual US states have and working off that.
Absolutely. And it's really crucial here because we've had this conversation on the show so many times with the likes of AstraZeneca, with the likes of Novartis, et cetera, where we're talking about their consumer base. Even Novo Nordisk has made this point. Their consumer base is largely in the United States, and we've seen that show up in the likes of EU exports, or European exports, I should say, to the United States. But there's also been a question of supply chains, and we've had this conversation specifically with AstraZeneca, where if you are concerned about a supply chain that extends into the United States but also extends into China, do you have to pick one side or the other? So that's the other piece where Donald Trump may add pressure, not now, but in a year when these 200% might kick in.
Well, I thought it was interesting the things that Bloomberg is hearing about the carve-outs for autos. It looks like the German car makers might see some reprieve just based on the fact that they'll get a quota for non-tariff cars because they already produce some in the U.S. But that really does lead some car manufacturers really to be hurt on this. Porsche and Ferrari, who don't make any cars in the U.S., could be, some stocks trading to the downside this morning. Meanwhile, BMW, Mercedes, Volkswagen, those names that have quite a decent production in the U.S. Might be a bit unscathed from the recent rounds.
Yeah, it's interesting that sort of luxury dynamic and being made in a particular location for some of these luxury names is perhaps part of the selling pitch. Well, it also might attract a tariff in the future.
And so the European Union now has to face what's going on in Washington. They're already facing what's going on in Beijing. They're also dealing with some old pushback domestically or within the European continent.
Yeah, we at least are seeing a few things going on, at least in the banking consolidation in Europe. UniCredit seems to be at the focus of both of these news lines this morning. UniCredit, the Italian bank, has increased its equity stake in the German lender Commerzbank. The move could give UniCredit as much as 29% of the voting rights if they convert their remaining synthetic position. The UniCredit has announced these changes after receiving approvals from the ECB, from the Federal Reserve, and from the German antitrust authorities. The UniCredit CEO Andrea Orcel has previously said that he may wait until 2027 for an all-out takeover of the German lender, and that's based on the 91% stock rally in Commerzbank this year so far. It's really made the takeover more expensive. So maybe nothing immediate on an all-out takeover, but I guess the momentum is moving in that direction.
I like that sometimes it's what you do and sometimes it's the style with which you do it. And Andrea Orcel seems to have attracted quite a lot of criticism within Germany for the hostile nature of the way that this is happening. And the German finance minister, when contacted by Orcel, said, well, look, firstly, speak to the company, and secondly, we don't like hostile takeovers, which we've seen a number of within the banking sector.
We absolutely have, but this is something where you start to see real tension between the way that Brussels is thinking and the way that all these other capitals are thinking, whether it's Madrid, whether it's Rome, whether it's arguably even London or Berlin as well. And I think this is really crucial here because at the same time that we're talking about this big infrastructure spend, getting steps towards joint debt, steps towards capital markets union, you see pushback from these individual countries, and that's what I think the EU is very clearly trying to address. And sometimes in the absence of addressing that, maybe hostile takeovers are the way forward.
Yeah, I mean, there's just so many fingers in the pie on all of these bank mergers, whether we're talking about Italy or talking about Spain. Who's got the most authority? Which ones are what the corporates are going to listen to? We've heard that the EU is going to be issuing a warning letter to the Italian government claiming that only the European Commission has authority to impose conditions on a recent merger. That one is on UniCredit's recent takeover of Banco BPM. Could pave the way for the Italian government to withdraw terms of the deal. So it does seem like a power struggle is happening between the EU Commission and the Italian government.
Yeah, who said single market? Right, it's in 9 minutes past 7. Let's tell you what else is coming up on the show, some of the conversations we're going to be diving into. We will be kicking things off with a panel on trade and the way way that the trade narrative is intersecting with markets. Laura Cooper, global investment strategist at Nuveen, will be with us, along with John Turek, founder and CEO of JST Advisors, in town for us. And now later in the show, we'll be hearing from Bernie Akong from UBS O'Connor, CIO, Global Multi-Strategy Alpha. So a lot to talk to him about. Momentum, is that the driver behind what we're seeing, or other things in the mix? Cecilia Malmström will be with us, former EU Trade Commissioner. A great conversation to be having today as Europe really pushing for some of these final exemptions, trying to get a trade deal across the line before President Trump is tempted to send a letter to Brussels. And Bob McNally will be joining the team, Rapidan Energy founder and president. A lot to talk about when it comes to the energy space. OPEC Plus is holding a seminar in Vienna, I know, Valerie, and so Jemana Besetcha, our colleague, is on the ground, and we'll be catching up with Bob.
Yeah, let's take a look at the other things that we'll be watching out so far this morning. The OPEC Plus seminar in Vienna is the first one on our list. The second to come at 10:30 a.m. is the Bank of England's financial stability report that's released twice a year. Will be catching our eye. Also at 1 p.m., Macron is having a bilateral meeting with Starmer as that visit continues. And then later this evening, out of the U.S., we have a big 10-year Treasury note auction at 6 p.m. And then at 7 p.m., we get the FOMC minutes from the June decision.
Lots to watch in the day ahead. Let's talk about what else we need to know this morning. Bloomberg has learned that SpaceX is discussing plans to raise money and sell insider shares in a deal that would value it at around $400 billion. That would mark the largest ever valuation for a privately held U.S. firm. Sources saying the valuation reflects the rise of its Starlink satellite internet unit and the company's proven ability to achieve new milestones with its Starship rocket program. The European Union is considering setting up a €100 billion fund to support Ukraine as its war with Russia shows no signs of ending. Sources tell us the fund may be a part of the EU's next 7-year budget, with disbursements starting in 2028 to maintain steady financial assistance to the war-torn country. And French President Emmanuel Macron urged the UK to recognize the state of Palestine in a speech to the British Parliament, emphasizing the need for cooperation amid rising Middle East tensions and uncertainty over U.S. support. Macron made the pointed appeal in the first state visit by a European leader to the UK since Brexit.
Coming up on the programme, we'll stick with some of the corporate news flow, see how it impacts markets. Meta makes a major investment in EssilorLuxottica for its AI glasses offerings. We'll check on the eyewear giant stock at the open. Plus, we'll keep a close eye on pharma shares after Donald Trump's heightened threat of levies on the sector. Looks as if they might not be trading much weaker. Maybe a year is a long time in pharmaceutical tariffs, so we'll wait to see how they perform. US stocks actually closed the day. US Pharma closed the day in the green. Up next, no extensions to tariff deadlines, according to the US president. How are markets reacting? We'll discuss all of that. We'll get into these guest conversations. If you want to join in, IB plus BBTV Go is the function on the Bloomberg terminal if you want to message the team. This is Bloomberg.
About 45 minutes away from the opening trade. Green across the screen, but not massively. We're seeing a higher by 0.2% on Euro Stoxx 50 futures. The CAC 40 seems to be the outperformer, but put that into some context here. It's been the underperformer in the last couple of sessions, so kind of maybe only natural to see a little bit more of a bounce back there. That's the one we're going to keep an eye on, higher by 0.3%. But you take a look at the FTSE 100, you take a look at the DAX, they're not blinking. A European summer, a Wednesday, I think is fair to say. The headline of this morning, though, that maybe we expected more of a reaction from, comes from Washington. Surprise, surprise. President Trump moving forward with his aggressive tariff regime, stressing he will not offer additional extensions on country-specific levies set to now hit on August the 1st. He's also indicating he could announce substantial new tariffs on imports of copper and pharmaceuticals. Let's parse through what we know here. Bloomberg's Katya Dmitrieva joins us from Hong Kong. Katya, just walk us through the latest here. What numbers stick out to you?
Yeah, absolutely. Markets definitely taking Trump a lot more seriously this time around than they were on Monday when he first announced the tariff levels that would be coming in August 1st. I think there was some debate and some question about whether August 1st would be a firm deadline. The thinking was that things could get pushed down the road again. And so what we heard from Trump is that, in fact, no, that is a firm deadline with August 1st. And there were also signs of him doubling down on places like India, where we were expecting a trade deal pretty soon, and he's now saying that there will be a 10% flat tariff no matter what. There's also the European Union and voicing frustration about some of the taxing and levies put on U.S. tech companies. And then, of course, we had pharmaceuticals, which face now a 200% tariff, unless those companies are starting to produce in the U.S. within the next year. And, of course, copper, which was the big one in the markets, where we had U.S. copper prices surging and then globally falling on this thinking now that there's going to be a glut, really, of this mineral globally. So there's there's a lot of numbers floating around, but basically the bottom line is that Trump wants the world to know how serious he is about tariffs, and that they could be coming quite soon as well.
Katya, talk to us a little bit more about the copper market reaction. How big of a moment is this, not just for the metals market, but for the U.S. economy?
Well, it's huge, right? You know, the surge of prices after that 50% tariff announcement, at least for the U.S. market, was a record. You know, we haven't seen that before. And the thinking there is that there's just not enough supply in the U.S. to meet demand. So there's going to be potentially sort of a decline in shipments of copper into the U.S., and then the rest of the world will have to pick up the slack of that. In other words, there's going to be a lot more supply around the world and prices going down elsewhere. There has been a lot of struggle to get factories online, to get mines online in the U.S. There's issues with First Nation sites. There's issues with environmental concerns as well as workers. So it remains to be seen whether Trump can get what he wants, which is, you know, copper mining and other mining moving back to the U.S. from the rest of the world. And 50% tariffs won't necessarily do that, although it will make things a lot more expensive.
Katya, thank you very much. Bloomberg's Katya Dmitrieva joining us with the latest news lines, and there have been a lot of them on the trade conversation from President Trump and the White House. Joining us now for more on tariffs and the market read across is John Turek, founder and CEO of JST Advisors, and Laura Cooper, global investment strategist and macro credit head at Nuveen. Welcome to the programme, both of you. Let's start our conversation with how the markets are dealing with all of this volatility then, Laura, and I come to you with that in mind. Are we sort of seeing diminishing returns to every tariff headline we get here, you know, a diminished level of movement in markets? Are we just learning to take this volatility in our stride? Is that what's happening here?
That is certainly what the price action is suggesting. And I think at this point, markets have a better understanding of the reaction function of the U.S. administration. And so there is this implicit expectation that we will see a backtracking of some of the tariffs that have been announced to date. I think the key risk, though, is the fact that markets aren't responding perhaps takes less pressure off of the administration, so they could continue to be emboldened on their tariff stance. And that, I think, is the key risk. If we look at the tariffs that have been announced this week in the letters, that could take the effective tariff rate up to about 25%. So significantly higher than I think most baseline assumptions assume now, about 10%. When that starts to feed through the economic data, if it does hold, I think that's when markets will really start to pay attention. But in the meantime, I think we're going to see those trade deals come through.
Yes, in the last 24 hours, constructive ambiguity, certainly something that came to my mind when thinking of just yesterday, we were sitting around this desk saying President Trump isn't quite committed to that August 1st deadline, and then he was more committed to the August 1st deadline. So things move fast and markets having to adjust. John, you think about this, no doubt, the volatility in markets and what that does to the U.S. economy. Probably you're also thinking about, as Laura says, if these tariffs hold, if they are implemented, how quickly does that show up in inflation? You know, we've been having a lot of conversations about that, about inflation. When do we start to see this actually in the hard data? And some of our copper conversation this morning leads me to wonder whether it's going to take a lot of months.
Right. No, I think, you know, to Laura's point, there's two sequencing elements to kind of how tariffs are playing out. There's one, the financial variable, which we saw in April can be quite swift, but we've also seen now can be quite muted relative to the headlines. And I think that you know, the two different reaction functions between the economy and the financial markets are just looking for clarity around the distribution. So, you know, for, you know, a few months now, we've seen, you know, most estimates of the effective tariff rate in the U.S. be pinned around 15%. And I think from a market's perspective, that's allowed us to feel a bit more immune to the actual, you know, volatility around the announcements. And for the economy, I think, you know, we're entering, you know, I think the Fed's talked about the summer months as kind of being a a place where tariff impacts should begin to show up. But I think for the economy, it's still very much an unknown in terms of what the impacts are going to be. And I don't know that sort of the lull in financial markets is indicative of a muted economic impact.
And if markets feel immune, is that complacent, do we think?
I think yes and no. I think in the sense it's complacent in the sense of it's still a big unknown in terms of what the economic impacts will be, especially in probably the Q3 inflation and growth figures. But I think for markets that once they have an anchored view of the distribution, I think it's much more easy for them to pass on the baton to what's kind of marginal. And a lot of them have decided what's marginal is AI, is fiscal, is things of that nature.
John, can I say something crazy here?
Yes.
Maybe very controversial. What if the markets are right? What if the dent isn't that deep in the idea that the U.S. consumer is still strong, the labor market is still strong, disposable savings as a percentage of income are still fairly and historically high? What if the tariff impact can be absorbed and therefore the markets have it right?
I think it's totally possible. I think that for the economy, my kind of starting point, going into this sort of episode is that we've had a gradual slowing in the labor market. We've had a normalization to trend in consumption, and we have pockets of weakness in sort of marginal areas of the economy, notably housing. So the question kind of is, if especially if the effective tariff rate is to go somewhere closer to 20%, can the consumer, really deal with that? Again, it doesn't have to be sort of in this binary, bad and good. It could be that, it could further, what I think is like a real growth weakening that seemingly is happening in the U.S.
Laura, a question to you here. Do you think that the July CPI print next week will tell us more about this tariff pass-through, or will it be more earnings season that starts at the end of the month?
Well, I don't think we're going to get much information in the July CPI print, and it's one of the reasons why we suspect the Fed is going to be on pause in July. And I think, if anything, the delay that we are seeing to August 1st for the new tariffs to come through, maybe the Fed won't have even enough information for that September meeting. We're still leaning towards a cut coming through at that point because we will have two non-farm payrolls prints ahead of that, which, to John's point, we do expect Q3 to show more of that economic deterioration come through after, maybe the front running of some of the data that we have seen so far is maybe masking some of that weakness. So I think at this point, markets are going to be driven more by earnings. But even then, it's probably going to be a fairly constructive story in the sense that they're probably going to message that we're past that kind of peak tariff fear, similar to the market reaction. They're probably just navigating this backdrop of uncertainty with more of a status quo perspective.
John, do you share that same kind of sentiment about earnings season?
Yeah, I think that the economy, I think it will tell us a good amount starting in Q3. I think it's probably, to Laura's point, it's probably a bit too soon for the July inflation report to sort of be this inflection point of like, okay, here's sort of the exact pain points of tariffs on the price side. But I think we are entering, I would say, a much more impactful period in terms of looking through for tariff effects. And I think it's also an impactful period not only in terms of what are the things we actually see, but how the Fed responds to them, because they've clearly kind of boxed themselves into looking at the July, August, into September data as sort of critical for sort of the next steps of their policy reaction function.
It's certainly a fascinating one. If we talk about the Fed reaction, we're going to have that conversation shortly. Treasury yields not budging, much like futures either. We are seeing Treasury yields higher by 1 basis point. But, of course, there is lots to digest. John Turek and Laura Cooper are not going anywhere. We still have lots to digest with them. They are staying with us. And there's still plenty more to discuss. We haven't talked about copper yet, pharmaceutical tariffs, not to mention the dollar. All of that conversation coming up, including the global bonds sell-off today as well. In the meantime, it's about 30 minutes away from the opening trades across Europe. When you look at the futures picture, light volume, light liquidity, U.S. futures pointing to the downside, European futures pointing to the upside. It must be raining in New York, sunny here in Europe. Stick with us. This is Bloomberg.
Welcome back. 30 minutes from the start of the opening trade here in Europe. So it's 7:30 here in London, Wednesday, the 9th of July. Let's have a look at the European futures picture. Stocks could go a little higher at the start of trade. Not sure there's a huge amount of conviction there, but we might see some green on the screen, up 0.3% on CAC 40 futures, for example. US futures, though, Kriti, are a little weaker. Again, there's not much in it. I guess it plays to that narrative around a little bit of becoming accustomed to the constant barrage of trade headlines.
I think that's a fair read for the bond market as well. We're seeing higher by about 1 basis point over in the U.S. 10-year. The European bond market reflecting that same kind of sentiment. The Italian 10-year is as exciting as it gets, down by a whole basis point, Anna.
Yeah, absolutely. It's hard. At least we got 3 decimal points on that board. Otherwise, you really have nothing to say. Valerie, let's come to you, because where we have seen some news flow, well, there's been plenty of it on tariffs, of course, which we've perhaps lingered on, but we haven't talked about Chinese inflation. And this matters, of course, because if China is producing a lot and can't send as much of it to the United States, it might end up in other parts of the world. And so what are we seeing on the inflation story over in China?
Well, we got a big miss to the downside when it came to producer price inflation, to PPI. The estimate was for 3.2%. We did get a negative 3.6%, so a bit worse than expected. Just another sign, maybe another signal that the Chinese economy is still struggling with overcapacity issues. That 3.6 number is the lowest that we've seen in 2 years. Maybe some early signs as well that tariffs are starting to impact some key sectors such as computers and electronic appliances. Take a look at my next chart, though, to just see how long the Chinese economy has dealt with deflation. We've been in deflation in PPI for 33 months, Anna. It's been a long time now, maybe some hints more that more stimulus is on its way. We did hear some reporting from the FT that the PBOC, the central bank in China, is having discussions with European lenders on how they handled zero interest rates. The momentum is definitely for some more monetary stimulus to come. We also have to keep our eye with what's going on in fixed income. Yes, Kriti, you mentioned there's not a lot of movement today, but the last 6 sessions has been pretty pummeling for the long-end bonds globally, not just the U.S. This is U.S. 10-year yields have risen 17 basis points in the last 6 sessions, a 6-session losing streak, I should say, for the Treasury market. And it might not end. We do still have a lot of supply to contend with. Today we get 10-year gilts. We also get long-end bonds and 10-year Treasury notes later. Thursday, tomorrow might be a big one. We get the 30-year bond auction later in the day, as well as the Japan 20-year bond. We've seen that auction tail by pretty historic levels. So again, the supply wave incoming might continue to pressure long-end yields.
Certainly something we're going to be keeping a very close eye on. What's actually driving the move? Is it the deficit concerns? Is it the trade tariffs? Is it the feeling that U.S. exceptionalism is seeing its end? Lots to digest. They're still with us for more on that. Is John Chirek, founder and CEO of JST Advisors, and Laura Cooper, global investment strategist and macro credit head over at Naveen. Laura, I want to come to you there. It's only been a few weeks since we were worried about the deficit. We were worried about the big, beautiful bill and all that kind of moving this fleet from the long end of the curve. Or I should say flight, I think is the word. Laura, are those deficit fears assuaged now by the fiscal spend? I've heard this big, beautiful bill. Now, it used to be this kind of scary deficit widening thing, and now it's being characterized as a fiscal tailwind. Which is it?
Well, I think we're seeing very similar dynamics to what we saw back in 2016 when we had these kind of large tax cuts announced. Markets reacted. We had kind of the sell-off in the bond market. But then when we actually had the policies implemented, we saw a quick moderation thereafter. And I think we're in a similar dynamic now. And the question is, how much have markets already priced in that fiscal impulse? Some of the analysis that we've done suggests that a 1 percentage point increase in the deficit as a share of GDP equates to about 25 basis points on the long end. And we've already seen that kind of being baked in. So I think to our mind, there's a lack of a fiscal catalyst from here to meaningfully drive yields higher. I think, though, the risks stem from, potential for a higher term premium on the back of really the inflation-led tariff dynamics. And a key question kind of from the global bond complex is around the lack of a natural buyer base at the long end. I think that's really been driving a lot of the JGB moves. We're seeing that as well in gilts. And I think that's something that we're certainly keeping our eye on.
All right, so John, weigh in here, because if we're trying to find a buyer base, the easiest way to do that, if you're Scott Bessent, for example, is to move the issuance to the front end of the curve. You know, people can't get enough kind of money market funds right now. Is that a viable strategy? What does that do to the way this bond market is trading?
Yeah, I mean, I think that, something that we're seeing that's kind of global that we've kind of been discussing in terms of fixed income is that there's clearly been this step up to try and assuage investors that, sort of these long ends are well anchored in the face of what's, continuing fiscal deficits. I mean, just so far the last 2 weeks, we've kind of seen fiscal concerns reappear in the U.S., the UK over, pretty marginal impacts in spending. We've seen it now in Japan again with potential election catalyst. So, I think that what the market is kind of saying, a lot of these things around the edges, such as, moving issuance or, doing buybacks or SLR reform, a lot of these things are only at the margin, and it doesn't really solve kind of what's more structural. And the structural is just that there is an imbalance between buyers and sellers in the long end. And seemingly what the buyers want is sort of, I would say more fiscal credence in terms of getting that spending to be more controlled.
And so, John, you do think that the curve steepens, and is that because these long-end yields still have further to rise?
Yeah, I do believe in the curve steepener trade. I think that, what's interesting about it now is it can come from either leg, because we're sort of discussing about, fiscal concerns at the same time that we are probably restarting, central bank cutting cycles in a lot of these markets, namely the U.S., the UK. So I think that there's this, multi-leg element that's kind of interesting about steepeners. And I also think that there is this pro-cyclical element where governments have kind of pushed off the, fiscal dynamics to growth as opposed to kind of making more disciplined spending decisions. And that can kind of create a feedback loop between if growth is to be weaker, fiscal fundamentals can actually worsen by the GDP denominator. So I think that's kind of an interesting era that we're entering in sort of this fiscal dominance.
Yes, there's certainly been a lot of conversation about that dynamic in Europe. Where does that leave the dollar then, Laura? Because if you're talking about what's going to happen in treasury markets, we thought we understood the relationship between treasuries and FX, and then sometimes that gets turned on its head. So what are you expecting to see in the currency markets?
Well, I think there's been some debate more recently that, are we seeing the end of this de-dollarization trend, given the price action over the past several sessions where we've seen the resumption of those dollar bids come through? To our mind, though, we do still think that this is really more of a profit-taking dynamic in the near term. We've seen fundamentals, essentially, or the correlations with fundamentals break down this year, so we're not necessarily seeing that resumption of the dollar as a haven play. If anything, we see this as a secular, long-term trend where the dollar is going to come under greater pressure. But I think a key dynamic to watch for in the second half of the year will be around central bank divergence. We're clearly seeing central banks becoming in that data dependency mode. We expect, the Bank of England has greater capacity to cut than somebody like the ECB. So that's going to drive currency dynamics. And we think that that does drive divergence in dollar crosses through the end of the year. Japanese yen is something that we like, whereas sterling is something that we're cautious on.
John, what do you think about the price action this week? Because historically, at least in the last few months, whenever we've had tariff numbers be released, the dollar doesn't like that and it falls. We didn't necessarily see that earlier this week. And now do you think that this could be something new that's driving the dollar?
So I think that there's kind of two time frames that I'm thinking about it. I think sort of in the April dynamic, something that was very interesting is that the market was able to look through what I call like the first derivative of tariffs, which is that, as Scott Bessent would say, is that the surplus country pays the tariff, and the way they pay the tariff is a weakening of the currency. That didn't happen in April, and I think what the reason for that was the market sort of looked through it into the second derivative factors, namely that tariffs were a catalyst for fiscal spend in the rest of the world, they were a catalyst for structural reforms in the rest of the world, and the market saw that as sort of more positive places like Europe and Canada, let's say as an example, than the tariffs were negative. And, now looking into, potentially this sort of tariff episode, I think the market kind of has to probably in the near term refocus more on the first derivative because we've now digested some of those positive tailwinds in terms of European fiscal spend, Canadian structural reforms, Asia dynamics. So I think that over the near term, I think there's probably, the dollar could trade with a greater correlation to tariffs on the way up. But I think, more structurally, I think we've entered this regime where, these are catalysts for further policy actions that are positive rest of the world.
OK. And what do you think the U.S. administration really thinks about the dollar right now? Because we get this really interesting narrative from Scott Bessent where he says dollar strength isn't really about how strong the dollar is in any one moment. It's about putting in place the policies that will drive people into the dollar. Then you can have a debate about whether the policies currently enacted do that. But how do you interpret that kind of conversation or that kind of instinct from the U.S.?
So I think what Treasury Secretary said is totally consistent. I mean, I think the administration generally has a sort of a strong dollar policy. And, a dollar weakening within a strong dollar policy, while paradoxical, I don't think is a contradiction because, I think we have to zoom out and say where we started the year was a very big imbalance between the U.S. and rest of the world. And what that catalyzed was a 40-year high in the effective evaluation of the dollar. So we came into the year with a very, very strong dollar that, I would say was probably, detrimental to pockets of the U.S. economy. And I think we could still be in a world where, you have a quote-unquote strong dollar policy, and that can sort of coexist with the euro at 125 or 130.
Can you just play doomsday with me for a moment, if we
can?
It's the best part of this job. When you look at the euro dollar, I'm looking at it at the start of the year. We were at 103. We were having a conversation about parity on the expectation that this would sink. We've gone from 103 to 117, arguably 118, in the span of about 6 months' time. What happens if it swings back with the same exponential move that you've seen in the last 6 months over the next 6 months? What are the ripple effects of that?
Well, I think that the catalyst for that would kind of be a return to, I think 103, 105 euro was kind of pricing in a world of the U.S. is growing tremendously and Europe is growing at zero, and that is a dynamic that's going to kind of exist in perpetuity. That's kind of how we came into the year priced. And I think that, to return to those kind of levels, especially, in the context of, very divergent, possibly divergent monetary policy cycles, definitely divergent fiscal policy cycles, I think would require the market re-entertaining that view that the U.S. is, growing above trend forever and Europe is growing below trend forever. And I think that kind of level in the euro would, show that. I have a hard time thinking we sort of go back to that world, but I think those are kind of the ingredients you need to have a swift move back down in euro dollar.
Laura, let's end this conversation looking ahead a little bit and thinking about the earnings story that we're yet to unpack and yet to digest. Just as you said that the July print on inflation might be too early to see really what's going to happen on inflation, will this quarter, talking about the second quarter, of course, will that be too early to really get a clear picture on tariff impact? I mean, as ever, it'll be all about the guidance, I'm sure.
Well, and it was interesting in the last quarter, we really saw three key buckets of how corporates are navigating this backdrop. The first was we saw a suspension or an abandonment of guidance, and that was largely in sectors that are driven by tariffs. So pharma, we can think about kind of other key sectors on autos. And then we had those that are just kind of taking a status quo approach, wait and see. And then we had those that are kind of outlining their own assumptions for tariffs. So I think we're going to see a similar dynamic this quarter. I think the interesting dynamic will really be in the divergence that we're going to see between the U.S. and Europe. So earnings expectations are quite low in both regions. We expect a contraction in the second quarter year-on-year in Europe, but quite bullish in the U.S. And I think that's one of the reasons why we've actually gone overweight large cap equities in the U.S. in our mid-year outlook, because we think that bullish earnings revision momentum will actually be a key driver of U.S. equities, largely led by tech, whereas Europe, yes, earnings are going to be supportive, but more in the medium term as it's clear that fiscal impulse comes through. So I think that's something to watch.
OK, thank you both very much. Thank you to John Turek, founder and CEO of JST Advisors, and to Laura Cooper, global investment strategist and macro credit head over at Nuveen. Coming up on the programme, we dig deeper into European metals and mining stocks after President Donald Trump indicated the US would implement a higher than expected 50% tariff on copper imports. This and the other stocks that we're watching next. This is Bring Back. .47 here in London, so we have 13 minutes until the start of the European equity trading day. We'll certainly be watching anything to do with metals at the start of our trading day, but let's go from stock markets to the underlying commodity. Kriti has certainly been looking at the copper story this morning, and Kriti, I see that Goldman says that US copper imports may rise ahead of the import tariff, and I'm reminded that the US administration yesterday said the end of July, beginning of August will be the date on which they implement this tariff, so there is still time if you're sending copper to the US to get in ahead of that tariff, I suppose.
Absolutely, and that's what you're already seeing kind of showing up in some of these markets, which brings me to what caught my eye. It's that price action, the bear and the bull case. Let me walk you through it. Let's start with the bull case here, because this idea of importing U.S. copper onshore is what's driving up the U.S. prices relative to the LME prices. That's what this blue line is over in the U.S. The white line, of course, what's going on the LME. This is really crucial as well, because it brings back to me this idea of what we saw with gold prices when there was this exodus of bringing gold onto the U.K. shores out of the United States, and you saw this kind of divergence in pricing as well. We're seeing something similar when it comes to the copper story. That's the bull case, at least, for the U.S. copper contracts. Here's the bear case, the idea that the inventories have been building up for quite some time. And what that does, though, is really limit, perhaps, or cushion some of the blow in terms of that kind of price action. And this is the chart I think you really need to pay attention to, because we're at copper stockpile levels that go all the way back to 2018, to pre-COVID levels. And that's a really crucial piece of this, because how quickly can you get through them? Yes, the copper is used in a little bit of everything. It's used in manufacturing, it's used in EVs, it's used in washing machines, et cetera, et cetera. But do you really need that much of it? Can you really absorb that much of it? And how much does the tariff pricing change for the United States? Well, let me tell you who it does change a lot for, and that is Latin American countries. In yesterday's price action, you saw a little bit of a move, not as big as I think a lot of people were expecting, but a little bit of a move in the likes of the Chilean peso, the likes of the Mexican peso, the Colombian peso. A lot of LatAm currencies that have that copper exposure from the export perspective did move. This is a 3-day chart just to kind of show you what I'm talking about here when it comes to the dollar versus the Chilean peso. And you can see weakness across the board. This kind of slight pickup, this is the headline from yesterday, only to come back down, which, Anna, I think really speaks to this idea that the absorption of this headline risk, of this supply risk, is actually perhaps larger than we anticipated.
OK, Kriti, let's stick with this theme and take it in a different direction. Our Markets Live executive editor joins us, Mark Cudmore, for 3 minutes on the markets. Mark, a lot of our attention has been given today to the latest tariff lines, of course, from President Trump, including the mention of a 50% tariff on its way for copper. How much does that kind of thing and what it does to copper prices in the US, very different to what it's doing to global ex-US copper prices, what relevance does that have to your macro view?
I think very large, but I have to say we're still kind of debating about what that eventual impact will be. I think that the cost to US businesses over the long term will be very damaging. It's not easy metal to substitute. And I think that the refining resources in the US will take time to kind of build up. So it's just adding an extra cost to US business. And we're seeing that already with the large premium in US prices that Kriti outlined there perfectly. I can't add any more insight to copper specifically to what Kriti said there. But I think in macro terms, it is emphasizing our already kind of prior view that US companies are going to find an increasing cost of business under this administration. Now, there's positive tax benefits, there's other things that are happening, but ultimately this policy uncertainty is damaging. But it'll take a long, long time to feed through. And I think it kind of helps the idea that US stocks will underperform over the next couple of years, but it's not really a short-term trading input.
Mark, you mentioned policy uncertainty there. Do you think that on average this week we've gotten more clarity or less clarity about where the end date or the end level of tariffs will end up?
A great question. I think we've got no real clarity this week. So, and it feels like there's a lot of news flow. But what's interesting is there's so much kind of news flow around tariffs, but people are kind of ignoring it. You remember how much 4 or 5 months ago we reacted to every incremental headline in tariffs. Now we kind of get tariff headlines and people kind of shrug and go, oh, what's the latest? You know, people are kind of jokingly debating them because we don't know what's eventually going to be implemented. We don't know what date. Sure, August 1st has been reiterated. It won't be changed again. But we've had that kind of promise so many times before. So everyone's just waiting to see not just actually what tariffs will be implemented and when they'll be implemented, but what is the hard data part? So one part is that tariffs keep on changing all the time and we can't take anything that Trump says on tariffs as literal. We just have to wait to the final action. But also the feed through to the data, because of that uncertainty, is taking much longer. So people are just going to wait for the hard data, which means the tariff story is probably still 2 or 3 months away from being felt in reality.
Mark, I feel like we said that in April as well. We were waiting for the payrolls data to shake up with all those Doge efforts, and that moment just never really came. Walk us through the complacency trade. We've talked about the stock market, the bond market, but why is EMFX not having a bigger reaction? What's the canary in the coal mine there?
So I don't know whether I call it complacency. I do agree with you, Kriti. I thought that we'd start seeing the tariff impact by the June date, June prints, which is the June data in the July prints. Sorry, and that's not really happening yet, which means the data reaction is coming through much lower, and it goes to that point that we just don't know what the end game is, so people aren't reacting as quickly. I don't think there is a canary in the coal mine for EM. I'm quite positive EM in a dollar depreciation world that is positive for EM.
It's a fascinating one as well. When you arrive in London soon, Mark, I'm told, we'll dive into the story a little bit more. Bloomberg Markets Live executive editor Mark Cudmore joining the program this morning. You get more analysis from him and the team. MLIV Go is the function on your terminal. Let's go from the macro to the micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. Some metals and mining stocks clearly in focus here in Europe today, given this volatility we've seen overnight in the pricing. Now, the important thing is to look at the companies exposed to the US copper, where we saw that spike up around 13% at the close in the COMEX price. Now, the ones exposed to that, according to a note out today from Morgan Stanley, is Antofagasta, Rio and Glencore. Those that aren't exposed to US, that are more exposed to that drop down in LME prices, potentially going to underperform today. So keep an eye on those mining stocks on the screen. And then also a couple of kind of secondary effects from this. Cables makers, wires makers, company that make the wires that are used in industrial markets, potentially in focus as well. Then we've also got EssilorLuxottica, this Bloomberg exclusive last night around an investment from Meta, the owner of Facebook, taking a 3% stake in the company, potentially even moving that up to 5% over the longer term. We saw that spike up in the ADR of EssilorLuxottica last night. Bear in mind, this is an interesting company because it sits between both the healthcare sector and also luxury goods as well, because they've got both the prescription and also the sunglasses business. It has outperformed both of those. Keep an eye on them. Finally, profit warning out today from the advertising giant WPP in London. That one is set to be lower at the open of trading.
Thank you very much, Joe. Yeah, we'll see if that has a read across into the likes of Publicis, to others within that sector as well, if we get some weakness across the media and advertising space as a result of that. Coming up, it is the opening trade. Futures have been pointing tentatively higher. US futures, though, a little more mixed, actually entirely flat this hour. We'll be back with Market Open here in Europe. This is Bloomberg.
Two minutes away from the opening trade across Europe. Green on the screen, it seems, at least when we closed markets yesterday. Here's how we're set up into today's session. The white line, of course, is where European markets closed into positive territory. And then you had all the drama out of Washington. And that's where you start to see all of this volatility, all this wonkiness, really tied a lot to the commodity market. That's what the S&P 500 priced in yesterday. Europe still has a little bit of catching up to do, Val.
Look, futures are looking increasingly positive over the last hour. We're now seeing Eurostoxx 50 futures up 0.4%. FTSE 100 also in the green, up 0.25%, and DAX futures up 0.25%. Anna, what stocks are we looking at today?
Yeah, well, we're looking at the mining stocks, we're looking at pharma stocks, we're looking at anything that could be impacted by the latest news lines around tariffs. I'll dive into Prysmian, which is a Italian cable maker. Yesterday, some of the researchers were saying that this was going to dent margins, inflate costs, but actually the company out this morning saying that the copper US tariff may have a positive effect. So we'll see which way the market goes on that one and that wider mining space, cable makers, pharmaceuticals obviously in focus as well because of the mention of a delayed 200% tariff there. EssilorLuxottica is in focus also because of the news around Meta, and WPP is an interesting one. We'll watch to see if this has an impact on the specific business or whether it sticks to that or whether it has a sort of provides a downdraft for others within the space. But WPP trimming its outlook on weaker client spend and new business. Bit of a profit warning perhaps coming through from them, and that could be a downside mover at the start of trade. Kriti.
Absolutely. I mean, I think it's fascinating. There's so many individual stories. There's this headline risk here that we're talking from the tariff perspective. The S&P 500 priced in the volatility, and Europe is enjoying the European summer. Let's see if that sticks to in the opening trade. That is now time for those markets to open right here in London and across the continent. And right off the bat, we are seeing the FTSE 100 marginally positive. Let's see if it catches up to what the futures were pricing in. The DAX, I think, was the high performer, and the CAC 40 as well in the futures picture. The IBEX already opening up with about 0.3%. Is this a light volume, light liquidity complacency trade, or is there something to it? Is it the fact that maybe Europe may actually weather the storm a little bit better? We're going to dive into those details as well, because a lot of this is also reacting to the commodity sector and how much volatility we see specifically in copper. That's the ripple effect you saw in yesterday's session. Do we see it today? And right out of the gates, you are seeing the CAC 40 higher by 0.4%. I'm going to go ahead and say we've graduated, Anna and Val, from a marginal move, marginally positive, light volume, light liquidity, to an actual risk-on day. Val, is that fair?
Yeah, it is looking pretty decent so far. We have 392 stocks in the green, only 159 in the red. At the top of that basket, it's EssilorLuxottica with that tie-up with Meta, up some 3.7%, outperforming for the single stocks. When it comes to the sectors, it does appear that we do have most of them in the green, 16 sectors in the green, the top of that being banks, energy, and insurance. On the downside, we do have media, Anna, as the worst performing sector across Europe this morning.
Yeah, absolutely. The media sector is the worst performer, and within that, we don't have WPP open yet, and that's the source of the information. That's where the guidance, the weaker guidance, is coming from. But it does seem to be weighing on others within the space, in particular Publicis, which we mentioned is a sort of obvious read across from WPP. So that stock is down by, Publicis is down by 2.6%. Waiting to see where WPP opens. I am interested, though, that a lot of the stocks that we were watching, or that Joe was flagging to us to watch, away from the specifics of the copper production, but those that might use copper, so the likes of Rexel and Prysmian, which I mentioned, which is a cable manufacturer, they're higher this morning, up by 2.3% on Prysmian. So to their point, that I was talking about their headline earlier on, where they said this could actually be a positive for their business.
Yeah, it does look like basic resources as a sector is treading water today. It did outperform yesterday, so maybe some reasoning for that. But it does look like Antofagasta, you might have to help me with my pronunciation on that one, is dropping today. They do have exposure to the copper industry. Glencore, though, is looking like it's holding up pretty well.
It's a pretty interesting move that you're seeing, because on the other hand, when you look at the broader commodity sector, at least when it comes to the stock market reaction, broadly positive, which I think is an interesting one. The likes of Shell, for example, Rio even is higher this morning, which starts in kind of stark contrast to the dynamic you were just talking about there. We should also mention the healthcare piece as well, because you are seeing some of the laggards there being the likes of Novo Nordisk, Novartis, et cetera, as we talk about what that 200% may actually look like or mean, maybe not immediately, but down the line. Those are going to be certainly some stocks to watch. Let's get a little bit more context here on these markets. Bernie Akong, CIO for Global Multi-Strategy Alpha at UBS O'Connor, joins us around the table. Bernie, we've been talking all morning, and I want to say for a couple of weeks now, about the complacency trade, the volatility trade. We're waiting for more reaction, more headline risk to show up. When you hear a 50 or 200% number thrown out from Washington, we're so used to a bigger reaction. Where's the volatility?
Yeah, it's true. It feels like markets have almost just adjusted to this, these big headline numbers when it comes to tariffs. I think the reality is that when the detail comes through in the financials for companies, that's when markets will react now. So we probably won't see that, for example, say come through in inflation prints, for a couple of months, for earnings until, again, next quarter. But I think that's when potentially investors can get a bit more of a surprise. There's definitely inflationary pressures coming through in the system, particularly if you look at the supply chain that comes through Asia. There was a lot of diversion happening in the last few weeks and months of China going through Vietnam, through Thailand. We've now seen those rates, they're not coming down, contrary to our expectations. So that is going to require some change in inflation in the system.
So what's the canary in the coal mine there? What is the red flag? Is it the data? Is it monetary policy? Is it a Trump tweet or a Trump truth, as they're called, that shakes this market? What moves it?
I think it's core CPI. So we've been trending low in core CPI for several quarters now. I think we will see an inflection up in that in the coming months. And likely, as we've seen in the past, when you get these positive surprises, they don't tend to be small surprises. They can be big, big jumps and surprises. And I think there'll be a month where we get that, and that will really, kickstart the market into worrying about those things.
Can you put a number on that? What kind of upside reading are you expecting in CPI to year end?
I think myself and others have shown that we should be very humble in trying to make the predictions around CPI. So I'm definitely going to not put myself down to a number. But I do think there is an autocorrelation of inflation expectations. So when you go through a period whereby inflation's, is coming down, people tend to get more accustomed to that and vice versa. And we've seen that in the past. And I'm just saying, I think we are set up to have another period of that. These copper tariffs are extremely inflationary. I don't know how in the near term you can kind of circumvent and get around some of these high price hikes in terms of inflation coming through the system.
Is there a sector that you're keen on looking into in terms of their exposure to copper that, maybe the market and us all are underpricing?
So I think the cables you mentioned is an interesting one. So the miners, the reason they're not stronger this morning is because you have this basically spread gap now opening between COMEX and LSE. And most of the miners here will be exposed to LSE pricing, which actually in the short term could be under pressure. So you actually want to go through to companies which are going to be taking copper as input, putting that into their pricing. They won't be exposed to the same sort of tariff increases to that 50% degree. And so things like cable manufacturers, which are very heavy in terms of copper input, actually are a way of thinking about it.
So we've had, we've had some of that movement, as you rightly point out. So the likes of Prysmian and Rexel moving higher, perhaps, as you say, LME pricing more reasonable than it was here in London. Let's go to another sector that we've had a lot of interest in this morning. I've just got an opening price on WPP, in fact, and that stock is down by 14%. This, of course, in the advertising sector. That warning from them then weighing on the rest of the sector. So if we take this sector as a whole, advertising, Bernie, there's been a lot of talk about what damage AI does to the existing players in the sector if they can't embrace it, or what an opportunity it is if they can embrace AI. I mean, where are you thinking about the winners and losers when it comes to that dynamic?
I think that's absolutely true, and I think, there's a couple of stats on that I would put to the audience to think about. So first is, if you look at the number of searches that now on Google which don't result in any click-through to website, it's about 60% of searches. Less click-through to website means, less traffic, less need to have all the various advertising websites. So that's definitely disruptive. And I think AI overviews, which, Google are using themselves to disrupt themselves, that's resulting in something like 15 to 16%, less views already in the last few months. So you have to adapt and change. And exactly to your point, I think media and advertising companies which can advise their clients how to shift their spend in a very dynamic and quick way, which for a lot of these multinationals, they're not used to doing, reacting on a month-by-month, quarter-to-quarter basis on advertising campaigns. Those are the ones who are winning. And vice versa, the ones who, WPP didn't mention in their statement anything relating to AI, but I would say companies where they don't have that same sort of offering, they're definitely facing some of those headwinds.
And then something else where technology meets the older world, I suppose. Another story which encapsulates that is EssilorLuxottica and the news flow there that Meta takes the stake. I mean, I feel like we've been talking about the future as wearables for a very, very long time, and exactly what that wearable will look like. We've had forays into glasses that are, that can help you with all sorts that haven't necessarily, well, not everyone in the street is wearing them, put it that way.
No, that's true.
So why is this kind of development interesting for the wider narrative?
So I think when it comes to, this is specifically relating to agentic AI, which is when we're going to basically, walk around and say, book me my summer holiday, next month, or I need to buy some new trousers and socks, go and, what I bought in the past and do that for me. They will still require some sort of verification because from a legal compliance standpoint, you can't just have an agent going off and doing it for you. So I actually think the device is interesting.
You might not have been talking to your glasses, you might have been talking to somebody else.
But I think the wearables part actually makes sense in that regard if you think about it, because verbal verification will be a lot easier for us than having to click through on your device or whatever. So I think that just opens opportunities in the future, and essentially Meta is putting a lot of different chips to the table in terms of what the opportunity in the future could be.
Well, you mentioned this kind of idea of technology and AI and all these buzzwords, really. I want to macro this out as well, because it feels like the idea of momentum ultimately driving this market shows up in the tech story, largely in the States, but starting to show up here in Europe as well, maybe more pronounced in the defense sector, but it's still showing up. How long can that go? How reliable is that momentum?
So I'm particularly concerned about it for the next few months. The way I'd link it to the AI and tech part is that we, myself included, you see the pace of development, you get so excited, and as human beings, we just tend to over-extrapolate. And so with stocks, what that means is we tend to put higher multiples and think about what the growth could be next year. But the reality is that these comes in fits and starts, and it's not linear, the growth. And so I think we could be walking to a period where maybe into next year, some of the growth outcomes that eventually disappoint very lofty expectations, and that would put pressure on some of the momentum long basket things that people are crowded in and own a lot.
I wanted to ask you actually about momentum trades, because you mentioned in your notes some looking at momentum, and it got me thinking. I pulled up the factors to watch function on the Bloomberg terminal, was looking at US stocks. Okay, what role has momentum played year to date? And yeah, it's there, but market cap is by far and away the biggest driver of US stocks. And I mean, I guess that takes us back to the tech theme. That plays into the market just wants to get worried about tariffs, but then doubles down on tech investment. Is that something you're still playing?
Yes, so there is, I would say long-term structurally, it's hard to get away from large cap, particularly in the world of AI, which is going to require a lot of investment, not just in the AI tools itself, but also in data. So that is a structural trend you have in place. But more tactically, I would say there is a window where you could have a bit of a reversal that whilst maybe in terms of factors to watch, there's a disaggregation between the two factors, I would say there is a correlation and overlap between them, right? So to your point, large cap tech has been some of the best momentum performing stocks. Yeah. So if we do get that unwind, you will see some of the reversal on that. And I think the ownership in small caps means that it's just a lot less vulnerable to positioning driven dynamics.
Bernie, into your end, do you think that U.S. stocks will outperform Europe, or we continue to see this trend of the rest of the world outperforming U.S.?
I have a nuanced answer, which is if you have this momentum drawdown, I think it will weigh on U.S. more. But I think structurally for many of our stock pickers, when we've looked at the list of European companies versus the U.S. companies that you can really invest in, get behind, the U.S. still just has a longer list for us. So you ultimately want to buy that dip and that runway. A lot of the trends we're talking about, which are exciting from a growth standpoint, they just feature much more heavily in the U.S. than they do in Europe.
Bernie, thank you very much. I'm going to take a risk and ask you about restaurants. I didn't see one mentioned in your notes, but I know that you regularly... I'm assuming you're still eating out.
Absolutely, more than ever.
Okay, yeah. Go on, give us a top tip.
I mean, I think for the summer...
heat,
exactly. For the summer weather, I did write about one at Cold Drops Yard, which is a really great development. They've done an amazing job there. It's on the terrace. It's called Parallon. They bring small little charcoal grills to your table, so you kind of DIY it yourself. Super fun, go with a big group or, small casual date. Yeah, really good.
I'm feeling good now, because I've actually been there, Bernie. So that's
wow,
trendy, Anna.
Humble brag. Right, Bernie, thank you very much. Bernie Akong, CIO of Global Multi-Strategy Alpha at UBS O'Connor. Let us go to the core six, have a look at what's happening on some of these stocks that Guy in particular likes to keep an eye on, but we all keep under the radar, on our radar. Novo Nordisk down 1.3%. Everything in the red is the obvious thing to say about all of that. ASML down by 0.9%, which is interesting. On a day that started out quite positively, all our core six, some big heavyweight names across Europe, are actually trending lower. So there's some interesting sub-stories in the market this morning. Let's get to some individual stocks. Joe Easton has a briefing. Joe?
It's the big place to start, and it is the advertising stock space. A big drop down in WPP this morning following this profit warning. The stock heading down to 2009 lows on that stock. We're down close to 13% at the moment now. Just read a note from Goldman saying it's unclear whether this is kind of linked to the AI taking over in the space, cutting into the advertising, the traditional advertising spending, or whether it's a WPP issue itself. They are not winning business, particularly in Europe and Germany, was what they said in their statement and the analyst notes as well. And we're seeing that feed through as well into Publicis and also Havas over in Amsterdam. So a bit of a read-through coming into those ad stocks following that big WPP warning. Then in terms of the sectors, we had our eyes on miners, of course, and we are seeing a weakness. Kind of interesting given that big spike in the US COMEX copper price. Potentially, this means that these companies more exposed to the London price. The London Metal Exchange prices were down around 1% versus that big spike in the US. So potentially that is the reason for that there. But we are seeing a feed through into the metals prices in terms of the stocks that are kind of a secondary effect on those. So the wire cable makers like Rexel, and then, as Anna mentioned earlier, we have had this statement from Prysmian saying that they think this is probably going to be positive for their business. So those companies coming up, and also Rubis as well, the smelter company over in Germany. So a bit of a positivity coming through into the secondary stocks on that metal spike that we saw in the US yesterday. Then in terms of single stocks, Meta getting that stake in EssilorLuxottica around 5%, according to a Bloomberg exclusive last night. 3% currently, potentially going to move to 5%. And that stock gaining, similar to what we saw in the ADRs over in the US yesterday. The Ray-Ban maker, their second generation Ray-Ban Meta glasses. They've already sold a couple of million of those, according to an analyst report I read a moment ago. So potentially it's more positivity in that space. Then finally, to finish on a couple of defence companies. Firstly, Kongsberg. A decent order number for the company, but that stock among one of the many defence companies that's rallied over the past year or so. So coming down, expectations too high and therefore giving up some of that gain. And then finally, another one to bring you is Renk. A bit of a report, another Bloomberg report coming out, potentially going to spin off one of their gearbox units. This is more in the civilian space, but it's a defence stock, adding to a big rally over the past couple of years, of course. Renk rising around 6% in Germany this morning.
Joe Easton from our equities team walking us through some of those early movers. We thank you so much. Coming up on the program, as President Trump threatens a 200% tariff on drug imports, we're going to dive into the impact on the pharmaceutical sector, maybe what they should or should not be pricing in. That conversation next. This is Bloomberg.
Welcome back. This is the opening trade. Ursula von der Leyen is speaking about tariffs. Let us listen in.
I had a good exchange with President Trump earlier this week to help move things forward. We're looking for a reliable framework from which we can keep building our common trade. So the message is clear. We stick to our principles. We defend our interests. We continue the work in good faith. And we get ready for all scenarios. We will, of course, keep this House informed. Honourable members, the reason why we're working day and night to find a solution is because we believe tariffs are bad for business. And of course, we're not the only ones worldwide. Since the start of our new mandate, we already concluded new trade deals. You mentioned it, Antonio, with Mercosur, with Mexico, with Switzerland. We will work hard to finalize the deal with India by the end of the year. That would be an enormous opportunity, a huge market. And there will be more to come, because the world is looking for partners it can count on. And of course, Europe is such a partner. And for us, it is a key part for our foreign economic policy. And of course, a key part for our competitiveness. You mentioned the enormous market in Mercosur that is possible for our business and, of course, the consumers on both sides. These trade negotiations with these different countries can open immense new opportunities. So, yes, this is the moment of risk for Europe, but it is also the moment of opportunities for Europe, and it is a moment to seize immediately by all of us. Let me turn to the second topic. Tonight, 728 drone attacks on Ukraine have taken place. It is the highest number in a day since the beginning of the war, 728.
Ursula von der Leyen speaking from the European Parliament, making some key points when it comes to the tariff conversation, going on to name the fact that the world needs a reliable partner. She says Europe is it, and they are actively forging relationships with the likes of Canada, Mexico, Switzerland, India, calling it a moment of risk and opportunity. But the question remains, how does the EU handle the United States? And that's where the pharmaceutical story comes in. U.S. President Donald Trump threatening to slap a tax of up to 200% on pharmaceutical imports if companies do not move production to the United States next year. Following the story is our health reporter Ashley Furlong, joins us around the table today. Ashley, he didn't say those conversations were happening immediately on the 200%, but he did say the supply chain is one of question. We've had this conversation with likes of AstraZeneca, Novartis around this table. Your take on how easy that transition is?
So firstly, this is a massive stay of execution for drug makers. They were obviously, expecting in the next couple of months a tariff hit, and that's been massively delayed. We've had scores of drug makers already announce significant investments in the US, Sanofi and Novartis, Eli Lilly, and they're all planning to increase their manufacturing capacity. Obviously, it's a year is still quite a short time in a drug maker sort of supply chain, but by that time we should be able to see quite significant shifts in how drugs are produced in the US and how many drugs are produced in the US. So I think it offers drug makers a significant opportunity to actually meet those requirements from the Trump administration.
All right, Ashley, so you mentioned a year is a short amount of time for these companies to move production to the U.S., but where does that leave Ireland in all of this, which has long been, a really key site of pharmaceutical production for the EU?
This is really bad news for Ireland, because if drug makers say, well, we have to follow, Trump's request to move production, and they actually do that, then Ireland will be significantly hit. Eli Lilly has massive production in Ireland, and for the economy of Ireland, that's going to be a significant hit. So I think we're going to have to see, how that sort of shakes out in the next couple of months, and whether they can also reduce that 200% headline figure to something that potentially is more manageable, as they've already, invested billions in Irish production, and so to move that is also going to be quite difficult.
And what can you really, back to that point about it being a year, I mean, it might be time to do something to move at the margin, like if you've got a facility there to expand it, for example. But is it really, it doesn't seem like enough time to kind of break new ground and start production on something from scratch.
It's not enough time, especially for drug makers, as the tech transfer process takes a long time. Establishing facilities with complex biologic drugs takes a long time. But we have seen already, for example, AstraZeneca say that they have been able to move some production for certain drugs. If you already have a biologics facility, you can then say, well, we're going to sort of add another line with a different product that might be more for the US market. So it is, I think it does offer a window of opportunity, but they're definitely not going to be able to completely shift production in a year.
OK, interesting. Thanks for the details. Ashley Furlong joining us there, our healthcare reporter here at Bloomberg. Let's go from that sector to the banking sector. We're seeing some movement in share prices there as well. UniCredit has increased its stake in Commerzbank, becoming Commerzbank's largest shareholder after converting derivatives into stock. The moves gives Milan-based lender about 20% of the effective voting rights of its German rival. Let's bring in Bloomberg's Tom Metcalf, who has details on this. Now, this was foreseeable, wasn't it, Tom? I mean, the share price is on the rise. Commerzbank up by 2.4%, so I suppose it means something. But we knew he had these derivatives, and now he's turned them into sort of regular shareholding.
Yeah. No, exactly. And he's kind of been clear, once he's got all the necessary approvals, this is the step Shell is going to take. So as of today, UniCredit now own a fifth of Commerzbank, and it will, as you said, rise to 29% when the second tranche gets converted. Why he's doing that is because, holding derivatives obviously is effectively holding 29% of Commerzbank, but it's not quite the same as actually holding the shares. So it adds a little bit of stability, gives that certainty that UniCredit aren't, kind of going to back away anytime soon. And Shell himself has said, look, I'm still interested in a takeover. He thinks it's too pricey right now, given Commerzbank has almost doubled in the past year.
What made that happen?
Well, exactly. It's sort of what came first, the chicken or the egg. But basically, he's just sort of setting out his stall. And what's interesting is, the dynamics of this is it does put a little bit of sort of extra sort of, I guess, spotlight on the whole situation. And Commerzbank are no doubt watching it closely.
And, of course, UniCredit also feeling some heat from Rome itself, who in turn is feeling heat from Brussels. Who's in charge of the banking consolidation story, Tom? Is it Brussels or the individual European capitals?
Well, it depends who you talk to, and it'll be really interesting today to see how Rome does respond to what we expect, a letter from the European Commission basically saying, hey, no, this is our job to decide on these type of mergers, in this case between UniCredit and BPM. But no, that'll be one of the things today where there will be an Italian court also ruling on this merger. And for me, that's the fascinating thing is, will Italy say, perhaps they'll say something similar to the European Commission, or more likely, are they going to say the opposite? And how on earth, both Rome and Brussels are going to square this circle is really interesting.
And does that set a precedent for Madrid and other spots as well? Bloomberg's Tom Metcalf walking us through the story in European banking consolidation. We thank you so much. Coming up, we're going to stick with the conversation in Brussels and whether or not they can secure a trade deal with Washington. Will it satisfy its member states? Former Trade Commissioner Cecilia Malmström joins us next for a conversation on what to watch, what we can expect, and what levers to pull. Stick with us. This is Bloomberg.
The European Union is not afraid of open markets, is not afraid of negotiating with others, is not afraid of competing in the world economy. It's just that it does not want to trade with other countries with a gun in its head. It does not appreciate extortionary trade policies, which is a bit what is at the moment facing with the current US administration.
That was the former Spanish foreign minister and veteran trade official Arantxa González speaking to us just yesterday morning. Well, we're still waiting for further news around a European-US trade deal. It seems it is nearing. Bloomberg is reporting its negotiators, Europe's negotiators, are focused on securing carve-outs for key industries, including aerospace, autos and spirits. It comes as the German finance minister says any deal with the US, quote, must be fair, threatening countermeasures if an agreement is not reached. Joining us now is Cecilia Malmström, non-resident senior fellow at the Peterson Institute for International Economics and EU Trade Commissioner, crucially, from 2014 to 2019. Cecilia, very nice to speak to you this morning. So it seems as if we are heading towards some kind of deal, but help us understand the difference between a full trade deal that we might have talked about 10 years ago and what we might get here, something called a framework, perhaps. How much detail would you expect this to contain?
Well, good morning. It's very different this time. If you want a full trade deal that is comprehensive, it encompasses everything from services, goods, subsidies, energies, sustainable development, public procurement, etc. That takes years to negotiate. We tried that once with the US. It was called TTIP. Around 2/3 of it is done. The rest is somewhere in the freezer. It's not on the agenda to take it out right now. What we are looking at is some sort of framework, some sort of terms of references. And having in mind the unpredictability from the US administration with the new tariffs popping up and down and delays being changed all the time, it's very hard to see how something more substantial can come out of this. The EU is looking for a smaller preliminary agreement and try to get the tariffs down as much as possible.
OK, so something preliminary rather than a fully fledged trade deal, as we might have seen in the past. Can you think of, given your experience, Cecilia, can you think of low-hanging fruit, things that Europe could give away and not worry too much about to get this deal over the line with the United States?
But the EU already very early in this process offered to take away all the tariffs on goods if the US did the same. That was rejected by the US administration, so I think that is no longer on the agenda. So what we're looking at now is probably having to live with the 10% tariffs, but seeking exceptions on cars, on aircrafts, maybe on alcohol and a few others, if that is possible. The EU has also offered to buy more LNG, more gas, more soya beans, and as everything is mixed in this administration, the President Trump has also seen the commitment of the European states to invest much more in weapons and seek cooperation there in the framework of NATO. That has nothing to do with trade, but in this concept it has. So maybe this is a way forward, but we don't really know.
Cecilia, it's Kriti in London. You mentioned the offer to buy natural gas, offer to buy soybeans, among other exports from the United States. Talk us through what that means from the framework perspective. Does that put the idea of quotas back on the table?
No, I don't think so. The first time we dealt with Trump, that was also a small deal that was made. It also included soybeans and LNG and taking away tariffs on some seafood and porcelain, I think, so very tiny deal. So I think the Commission is trying to revive that again, buying even more LNG. But this is, of course, not the Commission buying gas. This is what member states does. But it can, in the name of member states, commit to increase its share, that we need more gas in Europe. When it's come to opening markets, I saw there were some rumors this morning on agriculture. I think that's very difficult to do right now because unilaterally opening the agriculture market from the EU side would be difficult to get parliamentary support for that in the different member states.
Cecilia, let's go back to talking about the actual rate itself. A little bit of a change in perspective from the European Union. We were going for zero to now accept that 10% flat line. Do you think that there is more appetite? Should Donald Trump say, well, it's not 10% anymore, it's 12% or 15%? How much willingness is there, given the carve-outs that may be on the table, for the European Union to be able to digest that?
Well, I think it depends very much on the carve-outs. Some member states are willing to go very far to get a deal if it secures a rather low tariff in key sectors such as, for instance, steel and cars. Other member states are saying that we don't want these tariffs at all. We didn't start this trade war. We want to trade on equal terms. We want to increase and facilitate trade even more between us because we do depend on each other and we have a historic good relationship in trade. So they are more likely to want to retaliate, and there are different kinds of lists of products for retaliation ready should things get very nasty. But what exactly that breaking point is very hard to judge.
Cecilia, as the EU is perhaps getting these retaliation measures ready, do you think this is having an impact for the EU, for the other trading partners it deals with? You know, von der Leyen was just speaking to European Parliament, talking about how it's dragging them closer to Canada, to Switzerland. We've also had lines from China just in the last hour saying the EU needs a rebalance mindset towards China trade. How do you view the trade situation, I guess, outside of the U.S. for the EU?
Well, the EU has trade agreements with a lot of other countries, and actually 82% of our joint trade is not with the US. So, of course, we are seeking to even deepen the existing trade agreements, concluding ongoing negotiations, ratifying done negotiations with the countries of Mercosur, with Mexico, for instance. There are intense efforts to try to finalize something with India. And there are also talks about how the EU could have more organized cooperation with the CPTPP, the Trans-Pacific Alliance, where the UK just became member as well. So all this is showing that most countries of the world actually do want to trade. They want to facilitate trade. They want trade according to rules and norms and predictability. So this is a parallel action that the EU is doing, trying to expand and stabilize trade with other partners, and many other partners feel the same. China is a more complicated partner, of course. There's a summit happening next week, and we share lots of the criticism that the US has vis-a-vis China on unfair practices, subsidies, and non-market policies. So that is much more complicated, and I don't see much change there. Maybe something on the margins, but we have a lot of issues with them as well.
Well, Cecilia, with that view that you just expressed on China, do you think that the EU would maybe welcome policies from the U.S. that are trying to isolate China?
Well, not totally isolate, but the EU has offered, as part of a broader cooperation, some joint action vis-a-vis China, where we have joint concerns. For instance, the issue of dual use, for instance, the issue of subsidies. The main point for EU with China is that China is enabling the Russia war economy vis-a-vis Ukraine. And until that changes, I don't see any major rapprochement between the EU and China. But there are certainly things we could do jointly with the US.
Cecilia, thinking about where the talks go now, or what there is still time for between Europe and the United States, obviously we've seen a shifting timetable for some of this. August 1st now the deadline, it would seem, for the implementation at least of any new tariffs. I know that South Korea yesterday was saying that they wanted the sectoral tariffs to be treated as part of this conversation before August 1st, but that doesn't seem to be the way the Trump administration is handling things. How is it possible for Europe to come to a framework agreement that doesn't include answers on pharmaceuticals and on a whole host of other sectors that are being looked at by the Trump administration?
Well, ideally, we would have more clarity on this. But as you say, the deadlines are changing all the time. There are new proposals on tariffs on copper, on pharmaceuticals coming up. So we don't really know if an agreement is an agreement or if it stays now and then tomorrow something else will happen. And that's what makes it so difficult with the EU, because we need some sort of clarity. Our businesses need some sort of clarity. And that's why I think there will only be some very small temporary agreement, and the EU will signalize that we are willing to sit down and seek deepening on other areas as well, but we need to get something as well. We're not going to give up, because right now we are being punished for nothing. And if we want to facilitate trade between us, and the US needs trade and investment from Europe, we need to get something out of it as well. It's not it takes two to tango. But I'm not very optimistic. I think there will be a very small deal, kind of like the one the UK got.
Cecilia, I want to circle back to one of your earlier comments that you made in terms of the European Union offering to buy some of the U.S.'s largest exports. You mentioned natural gas, you mentioned soybeans and other agricultural products, among others. There's one that you notably didn't mention, which is, I believe, the United States' second largest export, and that's Boeing airplanes. We know there has been a question of competition, of course, between Boeing and Airbus, lots of supply chain struggles on both sides, lots of safety struggles on both sides. Cecilia, walk us through that conversation. Is that something you think the European Union would be willing to budge on, buying more Boeing aircrafts for European carriers?
I haven't heard anything about this. As you said, this is a conflict that dates back almost 20 years ago, and we have been suing each other in the WTO for subsidies, Airbus, Boeing, etc. So this is a long conflict. There will be many trade books written about this. So I don't think this is on the agenda. I know the British, in the UK deal, there were talks about Airbuses, but I haven't seen anything about this in the US, in Europe, sorry.
Well, we look forward to seeing if that changes. Cecilia Malmström, non-resident senior fellow at the Peterson Institute for International Economics and former EU Trade Commissioner. Thank you so much for joining the program. Coming up, the other thing traders have to really weigh here is signs of swelling U.S. crude stockpiles just days after OPEC Plus announced a surprise increase in oil production. We are live in Vienna at the OPEC seminar to find out more. Stick with us. This is Bloomberg.
Welcome back. This is the opening trade. We are 44 minutes, I can find the clock for a moment, 44 minutes into the European trading session. And we have actually gains across these European equity markets. Not all of that positivity filtering through into the mining sector. We see some weakness there. But we've got some interesting dynamics. Some sectors that are related to that mining story actually doing okay. Those that use copper, certainly if they buy it on the LME, looking a bit cheaper than maybe it did. So some interesting dynamics under the hood. Let us talk about what's going on in metals markets. President Trump is pushing forward with his aggressive tariff regime, stressing he will not offer additional extensions on country-specific levies set to now hit in early August. He's also indicating he could announce substantial new tariffs on imports of copper, which saw a record spike yesterday on the US exchange. That's for US futures of that metal. Joining us now, Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. And it's the commodities bit we'll pick up on in this moment then, Will. So the copper story really kind of exploded. Certainly US prices of copper exploded yesterday, and now there's an increasing divide between the London pricing and the US pricing. What are we hearing about the volatility that this is creating for those who produce the stuff and those who use the stuff?
It's a very difficult situation, which is producing incredible opportunities to trade for those people who are wanting to take a risk on exactly when and if these tariffs will come. The copper market has been driven in recent months by the expectations of tariff, and what that means is people are taking metal out of the London Metal Exchange and shipping it to the US and putting it into the US market, which is why you see this big spread in prices, and people are able to make a lot of profit by exploiting that arbitrage. Now, he's promised to put in the sanctions at last, and the moment those actually come in, that arbitrage closes. So traders are trying to think, do I have time to get them more metal into the US?
End of July, early August, we were told.
Will he make exceptions for metal, which is on the way, which he's done in previous, when he's put tariffs on metals previously? So it's a very turbulent situation, and we saw that in markets overnight, where we saw this massive spike, and then it came back down, and it's difficult to trade, but potentially very profitable. The other point I would make is, as you said, there's this big spread between US prices and European prices. That's making copper, a key industrial import or input, much more expensive for the US economy, and they're not even getting the tariffs. So it's not raising any revenues for the US government, but it's imposing a big cost on the US economy, which probably is a reason why he will want to put some sort of tariff on sooner or later, but we just don't know.
Will, talk to us a little bit more about this stockpiling, the inventory buildup in the U.S. Is it at unprecedented levels? Is this something that maybe the U.S. economy can use for the next year, and maybe the effect of these higher prices won't hit until a few months' time? I think that's a very reasonable point. Obviously, as we've been talking about, we have seen this massive movement of metal stockpiles into the United States, and customers will be able to
draw that down, which may mitigate some of the impact of tariffs in the shorter term. But if these tariffs are here to stay, and you make copper much more expensive in the US, because we should remember it doesn't have enough of its own copper to supply itself.
A key importer, yeah.
It will have to keep importing some copper. You will eventually impose a big cost on US manufacturers.
Absolutely. Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities, walking us through that copper story. We thank you so much. But sticking with the energy conversation, speaking at the OPEC seminar in Vienna, the UAE's energy minister says the oil market needed the supersized supply increase that the OPEC Plus group agreed to implement over the weekend. This all comes as traders weigh signs of swelling U.S. crude stockpiles and the fallout from President Trump's tariff regime. Our very own Jumana Bersecci is live in Vienna for us. Jumana.
That's right, guys. So I'm standing right outside the Hofburg Palace. You can see behind me there's sort of a red carpet, some cars showing up now. Many ministers have just shown up, including His Royal Highness ABS and the UAE energy minister who you were just referring to. We are standing outside. We have Bloomberg News has requested accreditation for this event, but have not received a response despite multiple requests. That being said, plenty of discussions taking place here, and I'm really happy to further the conversation right now with Bob McNally, president of Rapid Energy. Really good to have you with us. Look, it is the first meeting of minds since, well, first the Iran-Israel war, but then also that OPEC Plus decision over the weekend to bring back extra barrels to the market. And the feeling is that OPEC Plus have changed their strategy over the last couple of months. Why do you think that is the case? Why do you think they've decided to accelerate the putback of these
Right.
Great
barrels? To be with you, Jumana. You know, I don't think they've changed their strategy. I think they've doubled down on their strategy. It's clear, going back to April, they felt there was an opportunity to bring back barrels faster. They're putting their barrels where their forecast is. They don't share, I think, the consensus is pessimism about demand growth. They're not as worried about macroeconomic weakness, and they're more cautious about supply growth outside of OPEC+. So for those reasons, they see a higher demand for their oil. And so far, they've been right. The oil market is tight, curves are backwardated. So I think they're just saying, look, we think this market can handle more barrels faster, and they're doing it.
And it's echoing what the UAE oil minister was just saying, Mazroui, about an hour ago. And he was saying that the oil market actually needs the extra crude that OPEC Plus is adding, but then also that inventories have not increased despite the further increases that the group has put out the last couple of months. When do you think that inventory situation changes?
Yeah, I think in its visible inventories, and he's right, Cushing is just about empty. Diesel inventories in the United States are extremely low. But we expect that visible inventories will start to build later this quarter and in the fourth quarter, if our forecasts are correct. We're a little more pessimistic on demand and a little more optimistic about supply growth from Guyana, Brazil, United States, Canada. So if we're right, we will expect to see visible inventories build third quarter, fourth quarter. If that happens, the backwardation in the front of the curve should convert to contango, and you'll start to see some price weakness. But that's just a view about the future. Right now, the minister's right. When you look out the window, the market is pretty tight.
Yeah. Is your expectation that they're going to complete the unwind of the full voluntary cut amount by September?
It is. I think they're going to do another 538,000 barrels a day, finish in September. Then the question becomes, will they bring back the 1.66 million of remaining voluntary cuts, and then the 2 million of OPEC plus wide cuts, both of which are supposed to expire at the end of 26. That's the debate I think barrel counters will be having.
Bob, how much of this decision do you think was taken to appease President Trump? He's talked about wanting to see lower oil prices. Perhaps OPEC Plus sensed an opportunity to, one, regain market share, but then also appease the U.S. president.
You know, in my view, from the Saudi perspective and the Emirati perspective, it's more of a happy coincidence making President Trump happy. Although President Trump wants lower oil prices still. His advisors have called for $50 a barrel. We're still well above that. But I think it's more of a happy coincidence. I think the main reason is the fundamentals. I think they keep their eye on the fundamentals. They saw an increase in the refining season. Now, here's the deal, though. These barrels that are being brought back in August are going to arrive in the refining lull in the fall. That's when we'll see, between runs dropping 600,000 barrels a day, a decline in the Saudi crude burn. So it's a little riskier But that's, I think, the main reason, the timing of runs and the health of the fundamentals.
So you said just now some of the president's advisors would like to see oil at $50. What happens to drill, baby, drill if oil is at 50?
It chills, baby, chills at 50. I can tell you, my clients in Texas are none too happy about this call for $50 oil. We're already seeing rigs get stacked and activity slow. We at Rapidan forecast shale oil will actually be down in the fourth quarter year on year. So it is not a happy time. They are not happy with this $50 oil priority, but that is the policy.
What is the outlook that you see for shale production next year if prices stay around these levels?
Pretty much flat to maybe slightly down. I think you're going to start to see more caution, maybe less hedging at work, and so more stacking of rigs. We have oil prices going down to the mid-50s going into next year, and in that environment, I think you'll start to see shale start to weaken a little bit.
Yeah, but even in that situation, you'll see perhaps less supply, less production coming through from the U.S., but that's not going to deter some of the other non-OPEC supply that's coming to the market.
You're absolutely right. And we also have our Gulf of America or Mexico, depending on which you wish. But those projects are actually adding to U.S. supply. Plus, again, Argentina is ramping up. Brazil is bringing on new projects. Guyana and Canada are. So we see non-OPEC plus crude up about 900,000 barrels a day, liquids a little more than 1 million if you add NGLs.
Let's talk about the demand side. How much of the tariff uncertainty is weighing, do you think, on clarity versus where demand actually ends up in the next couple of months?
So far, not much. We had a panic moment when Liberation Day tariffs were announced, and then when President Trump walked those back, relief. But look, here's the deal on the data. We have to look at the data. The first quarter started very strong. Demand growth year on year, well above 1 million barrels a day, 1.112. However, toward the end of the second quarter, it hit the skids, especially in China and for diesel. So warning signs started to appear. But the tariff issue and the uncertainty around interest rates as well shouldn't really start to hit until the summer and the fall. So that remains to be seen.
Final question for you. When OPEC say, or not them necessarily, but analysts say that OPEC are looking to regain market share, where is that market share going to come from?
Well, first of all, I have to disagree with that. I hear that all the time. I don't think they have a market share strategy. OPEC Plus is focused on 3 things: stability, stability, and stability. I think they are trying to make sure the market has the oil it needs to keep oil prices in a range. But to the degree OPEC Plus is going to be increasing production, I think where it's going to be coming from are places like the United States.
Yeah, I think the wind is giving us a cue that we probably need to end this. Bob, thank you so much. Really good to talk to you. That was Bob McNally, president of Rapidan Energy. And there you had it. It's perhaps less drill, baby, drill in the U.S. and more chill, baby, chill.
Absolutely. Jumana, thank you very much. Bloomberg's Jumana Besetcha joining us there with the latest on the energy market and oil specifically. Let's talk about other sectors in focus then on today's market. And the advertising sector is being really beaten up. In particular, WPP, that stock down by 15.6%. It is having a bit of an effect, Kriti, on others within the sector. Concerns about bookings from here, from clients.
Absolutely. Some deal news as well moving the markets when it comes to EssilorLuxottica. Meta investing $3.5 billion there on the AI glasses story. That stock sitting somewhere between the pharmaceutical sector and the luxury goods sector.
Yeah, and lastly, let's check in on how these copper tariffs are impacting European stocks. We are seeing miners to the downside. Rio Tinto, Glencore, those kind of names falling in today's trade, mostly because LME copper is down 2% today.
OK, Francine Lacroix will be speaking to the Irish Finance Minister, Pascal Donohoe. That's coming up in the next hour of programming, so don't miss that. They'll continue, of course, on the Pulse to take you through all of these market moves. European stocks a little higher this morning. This is Bloomberg.